Do you know exactly how much of your wealth you truly own? I mean, beyond the digital numbers flickering on your phone screen. Right now, the money sitting in your checking account is not physical wealth. It's a liability on a commercial bank's balance sheet, a promise, backed only by the collective faith in the state and the current system. But what happens when that faith is replaced by code? What happens when your money stops being an anonymous medium of exchange and becomes a programmable, traceable, and, critically, conditional unit of control? This is not a distant theory. It is the immediate, looming revolution known as the central bank digital currency, or CBDC. And if you are an English-speaking citizen in the US, the UK, Canada, or Australia, this shift is already moving from policy papers to practical pilot programs, poised to change your entire relationship with money, with government, and with the very concept of financial freedom. The system you currently navigate, for all its flaws, still operates on the buffer of cash. Cash is anonymous. Cash is sovereign. Cash provides a critical layer of financial privacy that no electronic system can replicate. A dollar, a pound, or a euro bill is a final settlement, a complete transaction between two parties that the state cannot easily track, tax, or prevent. The CBDC, however, is designed to eliminate that buffer. It's an evolution, yes, but not of convenience. It's an evolution of control. To understand the severity of this coming change, we must first reflect. When was the last time you truly reflected on the nature of money itself? Was it when inflation quietly devoured your savings last year, proving that your government's promise of stability was an illusion? Was it when global central banks printed trillions on a keystroke, fundamentally devaluing every hour of your labor? If you have felt the sting of inflation, if you have felt the frustration of a system rigged against the common saver, then you are already primed to understand the CBDC threat. Because the financial tricks governments use to quietly drain wealth are ancient, and the CBDC is simply the most sophisticated weapon ever forged to supercharge them. Let us strip away the polished marketing slogans, the ones that promise faster payments or greater security, and look at the raw historical pattern. For centuries, every power structure has faced the same financial dilemma: how to finance endless expansion, wars, and social programs without provoking a politically dangerous tax revolt. Ancient Rome faced this precise challenge. They had the silver denarius, a coin trusted across the known world because it was nearly pure metal. But running an empire is expensive. Instead of taxing citizens openly, Roman emperors like Caracalla used the silent trick: debasement. The empire pretended nothing had changed, but everyone holding those coins paid the price through rampant inflation. Their savings evaporated, their wages lagged behind, and merchants began refusing the debased currency, preferring to revert to barter or using older, pure coins. This was a silent, insidious tax on the entire population, designed to consolidate wealth and power upward. Now, fast forward to today. We don't have emperors scraping silver from coins. We have central bank governors and financial technocrats. Their version of debasement is not reducing the metal content, but removing the privacy and sovereignty inherent in physical cash. The current system relies on commercial banks. When you deposit money, it creates a layer between you and the central bank. If a CBDC is implemented, that layer disappears. Your money becomes a direct liability of the central bank. Think of it as opening an account directly with the Federal Reserve, the Bank of England, or the Bank of Canada. At first glance, this sounds stable, but consider the full implications. This architecture grants the state unparalleled visibility, and more importantly, programmability over every single unit of your currency. Imagine a currency where the money for gasoline expires if not used within a month, where your funds cannot be spent on certain politically disfavored goods, or where your savings automatically incur a negative interest rate, a fine for saving, if the central bank decides it needs to stimulate spending. These are not conspiracy theories. These are the documented, published capabilities and discussions surrounding a modern tokenized CBDC. The UK's Financial Policy Committee, the US Federal Reserve, and the Bank of Canada have all openly discussed the concept of interest-bearing CBDCs, where the central bank can set interest rates directly on your digital wallet, including negative rates. This is the ultimate tool for monetary policy, turning your savings into a lever for government economic control. When you remove cash, you remove the escape valve. If a negative interest rate is applied to your CBDC balance, you cannot simply withdraw it as physical cash and avoid the penalty. You are locked in. The illusion of permanent stability, the idea that the financial system works for your freedom, is the most dangerous error of all. History proves that money is not a neutral tool, it is a weapon of power. The CBDC is the moment that weapon is upgraded and pointed squarely at the financial autonomy of the average citizen. The American, the Briton, the Canadian, the people accustomed to a certain level of financial privacy and freedom, are about to face the ultimate test of economic sovereignty. We must recognize the pattern of financial control being repeated. Because as Rome learned 2 millennia ago, when money stops being real, society itself begins to unravel. The true danger of the central bank digital currency does not lie in the word digital, but in the words central bank. This transition is a direct power transfer, moving the primary economic relationship from the consumer-commercial bank dynamic to the consumer-state dynamic. It is the end of the two-tiered banking system that has defined Western economies for centuries, and its replacement with a single, unified, and controllable ledger. Let's break down the mechanics and why this architecture is being aggressively pursued by Western powers, particularly those accustomed to global financial hegemony. The US dollar, and to a lesser extent, the British pound, have long been anchors of global trade. That dominance is now threatened by tectonic geopolitical shifts, namely the rise of non-Western trading blocs and the weaponization of the SWIFT system through sanctions. The CBDC for these nations is a strategy to maintain financial relevance and control in a fragmenting world. But for you, the individual, it is a tightening of the financial noose. The CBDC is the ultimate tool for policy implementation. Forget gentle nudges or market incentives. A CBDC allows for what economists call precision targeting. Consider the COVID-19 pandemic. Governments struggled to quickly and efficiently deliver stimulus checks, often resorting to cumbersome paper mail or slow bank transfers. With a CBDC, stimulus could be deposited instantly, but with an expiry date, a use-it-or-lose-it mandate designed to force spending into the economy immediately. This is not about efficiency, it's about forced economic behavior. Furthermore, the central bank gains the ability to enforce negative interest rates with surgical accuracy. In our current system, when central banks try to apply negative rates, commercial banks act as a buffer, and people can theoretically withdraw cash. A CBDC removes both the buffer and the cash. Your savings become a captive resource, forced to circulate or face punitive fees, eliminating your ability to simply save money during times of economic uncertainty. This mechanism alone fundamentally alters the core Western philosophy of savings, self-reliance, and capital accumulation. The key lie being sold to the English-speaking public is that a CBDC is merely a better version of bank deposits. This is false. A bank deposit is a loan from you to the commercial bank. You assume the risk, and the bank uses that capital to make loans. A CBDC is a direct liability of the state. It is a new digital form of currency issued by the state, placing the individual directly into the state's financial balance sheet. The Bank of England has explicitly explored the concept of a digital pound for this very reason, to future-proof monetary policy. The US Federal Reserve has published extensive research on its design and potential impact. Canada and Australia have similarly studied the implications for their already low-cash societies. This isn't theoretical. The planning is advanced, thorough, and focused on maintaining state control over the velocity and direction of money. The CBDC also acts as a profound solution to the state's massive mounting debt crisis. As the champion scripts reveal, governments have always used financial tricks to fund their endless appetite for borrowing, primarily through the silent tax of inflation. A CBDC offers a clean digital mechanism to manage this debt. By giving the central bank direct, high-resolution control over the money supply and the flow of funds, it can manage the money's velocity to prevent bank runs, enforce capital controls, and direct credit to specific sectors of the economy, all necessary tools when the national debt reaches levels that no civilization has ever carried before. For the average person, this means your financial actions are no longer a private matter. Every transaction, your morning coffee, your political donation, your purchase of disfavored assets, is a data point on a single, unified governmental ledger. This is not just a loss of privacy, it is the establishment of a financial surveillance layer over your entire economic life. The ability to transact becomes a privilege, not a right, contingent on your compliance with evolving regulations, social credit mandates, or even public health policy. The historical pattern is always a cycle of trust, debasement, and collapse. The Roman citizen slowly watched the silver disappear from his coin. The German citizen in the 1920s watched his paper mark become worthless after the heavy debt load of World War I. The modern CBDC is the next logical step in this cycle. It is the final act of monetary debasement, not of value, but of freedom. The financial tricks used throughout history, debasement, forced loans, and wealth transfer systems, are all streamlined and perfected within this single digital architecture. We are standing at a hinge moment in history, a moment where the choice is simple: passively accept the new architecture of total control, or proactively build a fortress of real assets that exist entirely outside the programmable ledger. The time to understand the architecture is now, because the window to act autonomously is closing rapidly. The coming question won't be, "What is my interest rate?" but, "Am I even allowed to transact?" The system is changing. The anchor of privacy provided by physical cash is being hauled up, and the new vessel is the CBDC, a direct, programmable financial link between the state and the individual. If Part 1 established the threat and Part 2 detailed the architecture of control, then Part 3 must be the CBDC Survival Guide. A pragmatic, actionable strategy for securing real wealth that cannot be programmed, traced, or confiscated by the coming monetary revolution. The core lesson of every single historical collapse, from the fall of the Roman denarius to the hyperinflation of the Weimar Republic, is this: when money ends, what survives is not paper promises, but tangible, productive, and counterparty risk-free assets. The survivors were always those who doubted first and built real wealth outside the illusion of permanence. The modern definition of a safe asset must be radically updated. Today, a treasury bond or a high-yield savings account is an asset within the control system. Tomorrow, in a CBDC world, such assets are subject to digital capital controls, transaction limits, and potential negative rates. Your survival strategy must therefore focus on assets that possess sovereignty, utility, and scarcity. Category 1. Sovereign. counterparty risk-free assets. The highest form of financial defense is possessing an asset that is nobody else's liability. These assets exist entirely outside the electronic ledger of the CBDC system. Physical gold and silver. For over 5,000 years, gold has served as the ultimate monetary base and the eternal hedge against government debasement. It cannot be printed, it cannot be debased, and it requires no central authority to validate its value. Critically, it carries zero counterparty risk. Its value is not reliant on the promise or performance of a bank, a government, or a corporation. Your ownership of it is physical, not digital. Silver, as the industrial precious metal, also offers strong utility and monetary value. The key is physical possession, not ownership of paper ETFs or digital certificates, which are merely proxies within the system you are trying to escape. Buy, take possession, and store it securely outside of major financial hubs. Land and productive real estate. Land is the one resource that governments cannot print. It is a tangible asset that retains value even when currency hyperinflates. Productive land, such as farmland or forestry, provides a double layer of defense: asset preservation and utility. The ability to produce food or shelter becomes invaluable in any economic shock. The survivors of every major financial crisis, from the Black Death's societal reset to modern political upheavals, have proven that ownership of productive land and real estate provides a fundamental barrier against state control and inflation. While property taxes exist, the underlying asset, the earth itself, cannot be digitally confiscated. Commodities and inventory. In times of monetary collapse, value reverts to things people absolutely need to live, build, and trade. This includes energy, vital metals, and long-lasting supplies. While direct ownership can be cumbersome, strategic long-term positions in global commodity producers provide exposure to real-world value that bypasses the fragility of fiat currency. Your focus should always be on production, the things that survive when the money ends, rather than consumption. Category 2, digital resistance and human capital. While the CBDC is a digital tool of control, not all digital assets are created equal. Decentralized cryptocurrencies, Bitcoin and select others. This is the ultimate digital paradox. The CBDC represents the apex of centralized state digital control. Decentralized cryptocurrencies, primarily Bitcoin, represent the antithesis, a digital asset with a fixed supply, secured by cryptography, and operating on a distributed ledger that no single government can program or control. Its value is derived from a global consensus and its absolute scarcity. For the English-speaking world, this is a financial exit ramp. Owning Bitcoin, held in a self-custody wallet where you alone control the private keys, means owning a sovereign digital asset that can be moved, stored, and transacted outside of the CBDC surveillance grid. The critical distinction is that Bitcoin is digital scarcity. The CBDC is digital abundance with programmable control. If you do not hold the keys, you do not own the asset. Specialized human capital and skills. The most valuable asset you possess is your ability to create value. History teaches us that in every collapse, from Rome to modern failed states, the people who survived and thrived were the ones who could still produce. The baker who could provide bread, the artisan who could repair tools, the merchant who could trade across borders. Your skills, be they plumbing, programming, mechanics, or medicine, are non-confiscatable assets. They are your wealth, tied not to a ledger or a banknote, but to your hands and your mind. Investing in high-value, durable, and in-demand skills is the most profound long-term survival investment. The shift to a CBDC is not the first time a government has attempted to solve its financial woes by manipulating the currency system. It is simply the latest and the most comprehensive attempt to enforce compliance and consolidate power. Your defense is not found in hoping the system will change, but in adopting the doubt-first philosophy. You must build your financial fortress around assets that hold value across cycles, assets that governments cannot falsify, and knowledge they cannot erase. The choice is whether you remain a passive saver whose wealth is subject to the digital whims of the state, or become an active owner whose wealth is anchored in the undeniable realities of utility, scarcity, and sovereignty. The history is clear. Those who prepare for the collapse are the ones who buy the assets from those who relied too long on the promise.